We've all heard the news, your typical billionaires and those folks like that, they're not paying 37%. There are so many ways around it. Just don't let that tax tail wag the dog, so to speak. Don't let that drive everything you're doing. Even though if it wasn't for changing the tax laws all the time, I don't know what I'd be doing for a living right now.
Alrighty, we are live. We will try to get this all wrapped up in our typical hour that we normally do. It'll be about 30 to 40 minutes of us speaking and answering questions that we typically get. Try to get you guys out as much information as possible. And then after that, we will have time for Q&A. I do recommend that as questions come to mind, go ahead and type them in. You're not going to interrupt us. We will take a look at them as we go and answer what questions we can as we go. Whatever we don't get to, we will come back to at the end on the Q&A portion of things. Let's get the fun stuff out of the way first for all the compliance people that are watching. I'm not a tax accountant. I am not an estate planning attorney. Everything that we're going to be talking today about is for educational purposes only. Please do not take any of this information, go out and run with it and implement it without talking to a specialist in whatever area that you are looking to implement new things. So please keep that in mind. Everything we're doing today is for informational purposes only. If you have specific questions to you, your business, or anything that you've got going on, please reach out to us. We'd be happy to talk to you, answer any questions that you have related to your specific situation. But again, please don't go out and implement anything that we talk about today without talking to a professional first. We'll go ahead and get going. For those that don't know, my name is Jaimin Garabedian. I'm the owner of Assurance Wealth Management. We host these webinars once a month to try to bring education to you and touch on different topics that may be relevant to you. But today we've got David Foster with us, who is the Director of Advanced Markets over at the Simplicity Group. He's an attorney by education, but has a whole litany of alphabet soup after his name, including, let's see here, let's see if I can get them all. We got accredited estate planner, chartered advisor in philanthropy, chartered financial consultant, and chartered life underwriter, which essentially combines to mean that he knows a lot about what we're talking about today. He's got a lot of experience with all of it. So David, thank you for joining us today and sharing your knowledge.
Absolutely. Hopefully you can hear me okay. Usually people just take out those letters and put in NERD. So
that is probably pretty accurate, but there's nothing wrong with that because that's what we need. We need to get this information out there, and somebody like you is perfect to bring it to us. So the way that this works and the way that this always works every month is that I'm going to just essentially act as an interviewer. I'm going to ask David all the questions that we get asked on a regular basis from our clients, from other people. We've also got some questions in here that were sent in prior to the webinar going live. We'll go through those. And again, please ask questions as we go. We will touch on them either as we go or when we wrap up at the end in the Q&A portion. But yeah, I mean, we're here to talk about business strategies, minimizing taxes, and just structure, all sorts of things business related that can make your business more efficient. But taxes are always a major concern for business owners. Well, really everyone. But when you and I were talking yesterday, you mentioned that you've seen many times, the tax tails wagging the dog. And can you explain what you meant by that and what you mean by business owners kind of over focusing on taxes?
Yeah, absolutely. And I'm probably going to take a longer route to get there than you'd probably like me to. But and starting off a conversation on the history of the tax law probably might have some people dropping off, but I'm going to do it anyway. So because I have a point to make, and I think it's an important one. I've been doing this for 34 years, and I've seen a lot. If you just think about the income tax in general, it started in 1913 with the 16th Amendment. And it was like 7%. Top tax rate, 7%. People, I think today, if it was top tax rate was 7%, I'd still get phone calls to say, Dave, can you get it down to 5%? So people, but it was 7%. What happened right after 1913? We had one war, first war. Well, it jumped up. All right. So they jumped it up to 77%. The top tax rate went to 77%. right? Prior to 1913, we didn't have income tax. We had tariffs and other things. But so we have an income tax now. They jumped it up to 77% to do what? To pay for a war. Well, then it dropped back down again after the war and went down to, I think it was like 24%. And then in 1924, it would, started to level out a little bit. And then what happened? We had the Depression. So in order to stabilize the government, they bumped up the tax rate again. Then it went down. Then what did we have? We have a war, the big war. We have WW2, right? So we have World War II. And it's interesting, if any of the listeners want to take a look at this, this is kind of interesting stuff. There was a video put out by Walt Disney in 1943. The government and Walt Disney got together with Walt Disney to create a video with Donald Duck in it, believe it or not, that talked about how patriotic it was to pay taxes. And it started a movement within this country to really think of taxes as something positive. It was patriotism. Patriotism back then was paying taxes, right? And so it's a different time, different world back then, to be honest with you. And the tax rate, the highest tax rate, I'm talking about the highest tax rate, or for the highest earners, 81%. Right? Keep in mind, the top tax rate right now is 37%, and you have to make as a married couple over $750,000. So 81%. Here's what was different, though. And obviously it paid for the war. And here's what happened. It didn't go back down. It just didn't, right? The highest tax rate actually got to between 1944 and 63 was 90% or higher. So if you had income in 1945, 1946, you could be paying, at the top one, you could be paying as much as 90. It was probably closer to 50, 70%, something along those lines. These are numbers that people today would be very surprised at. But that's how our country also got through the war, built the interstate system, created the infrastructure in this country, et cetera. But then in the 60s, they also did something else. We built things. So social safety nets, Social Security, Medicare, Medicaid, those kind of things, because we still had high taxes. Mm-hmm. And the Reagan years, right? And again, we're not going to be political today, but 1981 through 86, top tax bracket went from 70% down to 28. All right. So from there, it went up a little bit. Read my lips. No new taxes turned into, well, we have to have some new taxes. We get into the 90s now. But the highest tax rate was 39.6. And now it's down to 37%. So we've had 3 decades of people arguing over 2.6% tax. That's what I've seen. Yeah. One party wins and it goes up to 39.6. Another party wins, it goes down 37, and they have parades. But that's where we are today. We're at 37. The reason I say that, a long way to get there, is that the tax tail does wag the dog sometimes. People are so attuned, and there's so much PR, and there's so much, hey, don't give money to the government. And the patriotism of paying money into the government to fight wars and do the things we do is kind of gone. It's a bad thing. Taxes are a bad thing. And so people think of it as, well, I don't want to pay taxes. Well, there are some times that actually it's a good thing to pay taxes. And I don't mean because of what the government does. I mean because something like a Roth IRA might make sense to you. Mm-hmm. And that's paying taxes today so you don't pay taxes later, because they might go up. At some point in time, they might go up. So this whole idea that no matter what I do, I have to not pay taxes. There are some financial strategies out there that might be very beneficial to you that might not have the tax advantages you want, but it helps you with creditor protection. It helps you control the asset more so. It helps you create liquidity. Sometimes you need liquidity. Sometimes if interest rates are high, I don't want to borrow from the bank. I want to use my own money because it would be cheaper. There's a whole host of different financial strategies that we come across where it's not taxes. And that's the whole idea of tax tail, not letting the tax tail wag the dog. I've run across it in certain charitable planning solutions where they'll talk about a particular strategy and someone will say, yeah, but what about the estate tax? And listen, you're trying to give to charity. Mm-hmm. Won't worry about estate taxes right now. It's still a good idea. It still works because besides creditor protection, liquidity, and control, purpose matters too. What you do with your finances, you have a purpose with it. And sometimes we just let that thing get in the way. And the highest is 37%. And over the last 3 decades, there have been so many tax provisions put in that allow that 37% to be lower. We've all heard the news, your typical billionaires and those folks like that who may not be on the call today, but if they are, they're not paying 37%. There are so many ways around it. Just don't let that tax tail wag the dog, so to speak. Don't let that drive everything you're doing. Even though if it wasn't for, taxes and changing the tax laws all the time, I don't know what I'd be doing for a living right now.
Yeah, it's funny that you talked about the history of it, because one of the things that we used to present to people was about Reagan, when he was actually an actor, that there was a year that he only did one movie, and he'd offered to do multiple movies, and he always told everybody he's only doing one, because between the federal tax and the California state tax, if he were to do a second movie, he wouldn't even get paid on it.
Yeah, right.
So it was just one of those things that his first movie took him into the highest tax bracket. So if he ended up doing another movie, it was like 94% that he'd be paying in taxes. He's like, I wouldn't even get paid for the movie. So why do it?
At that time frame, yeah. There was a point in time when the highest tax code was actually only applicable to one person.
That's wild. But, we are here to try to talk a little bit about taxes and a little bit about, lowering those taxes. But I think it's very important to say that that's not the only thing that you should be focused on when it comes to running a business or even running your own financial life. Exactly. But when you are working with a lot of these high income professionals or business owners, what do you typically see as kind of a common, most avoidable way of tax efficiencies, like common things that almost anybody can do?
Well, the first thing I would say is this, and it kind of goes along with what I just mentioned, is that, and that's a kind of a broad question. The first thing to realize is there's been a lot of talk about simplifying the tax code, and we've done anything but. Doesn't matter who's been in office and what administration, what Congress is in. It has gotten extraordinarily complex. With each new tax legislation, we just had a new tax legislation come up not so long ago, and that was on top of the one in 2017, which was on the one in 2001, and on and on and on. And it's gotten to the point that I think that there's frustration with taxpayers, business owners, high net worth clients that I work with, et cetera, because it constantly changes. And so the unfortunate part of that is that it has become so complex. Think of it like doctors. So you don't say, one person has a back problem, another person has a knee problem, another person has something going on with their cardio, someone else has a whatever. You don't go to one doctor. Your general practitioner is not covering all those things. Mm-hmm. You have anesthesiologists, you have surgeons, you have every kind of different practice. But somehow in the tax world, they run to a CPA. And guess what? I've seen this. They can't be experts in everything. Doctors can't be. They all went to medical school. Yep, you all got your CPA. I have a legal background. I'm telling you right now, I get asked questions at parties all the time. I'm like, I have no idea what you're talking about. I don't do divorce law. Right? We don't all know everything there is to know about everything. You focus on certain things, and so the key thing that I'd emphasize is, as far as what's high income professionals do that create inefficiencies is to not have practitioners out there that are specialized in certain areas.
Yeah.
Business owners, you need a tax professional, and that might come from financial advisors. It might come from an actual CPA. It might come from a tax attorney, but interview them. Take a little bit more time interviewing the professionals that you work with to make sure that they are experts in what it is your life requires.
To that point, that's why you and I work together, is that I realize as a financial advisor and a wealth professional that I don't know everything about everything. So what we've done is create partnerships, and people like you, people like the CPAs that we work with, the estate planning attorneys that we work with. I mean, we've created this network of people because, look, business owners and higher net worth individuals have more complex strategies and needs, and it takes a team to do that. If you think you're going to get that all from one person, you've either got the world's smartest person or you're in for a rude awakening.
Exactly. Yep. So that would be my first piece of advice to anyone. And I know it's not specific to a particular tax code section.
Sure.
We'll get into some of those a little bit later. But as far as inefficiencies, it usually becomes from, I hear this comment very often. Well, why didn't my And I am not in any way, shape, or form blaming CPAs. That's not what I intend to do. They're professionals. They know what they're doing, et cetera. But they can't know everything. But the common comment that I get is, well, why didn't my CPA tell me that? I work in the financial services world. A portion of what I do has to do with insurance. I just had a conversation just yesterday where the tax advisor, the high net worth client, and another financial advisor didn't know about something called 101J. And it's very important. And it's been around since 2006. They probably came into the business in 2010, so they didn't know when it popped up. And they have life insurance policies where the death benefit may end up being taxable.
Oh, geez.
For a solution, all because they didn't fill out a particular form, a notice of consent form. I mean, there's tax laws that have become so complex that if you don't have an expert, if you're dealing with insurance policies, deal with somebody who knows insurance, and they're professionals. Financial advisors, financial services, the same thing. I ran across a CPA recently who does nothing but tangible property regs. Mm-hmm. Before he even talked to me about it, I wasn't even that familiar with it. Came out in 2014. It's a requirement that all business owners have to pay attention to, tangible property regs. And he can come around and he can save you tens of thousands of dollars on taxes by following the law. It's nothing aggressive. It's just doing what you're supposed to be doing. Yeah. So it's finding an expert, finding people, and understanding that there's probably specialists that you want to talk to. It can't just be, your brother-in-law who passed a CPA exam 3 years ago or something like that. If you want the best advice and you don't want to have inefficiencies in what you're doing, find an expert.
And so, again, kind of along the same lines with finding an expert is, what's so relevant these days is social media and YouTube and all these things where you find all these quote unquote experts, right? And they tend to spread, from what I've seen, a lot of misinformation, some good, but a lot of misinformation. What have you seen as some of the biggest misconceptions that people have about reducing their tax burden and doing it legally?
Okay, so here's the rub. Not only is the Internal Revenue Code complex, but there are individuals out there trying to look to take advantage of it, and they will tell you what you want to hear. So I get on a constant basis, hey, I'm a business owner, my business is doing really well, I'm very profitable, and I don't want to pay taxes. Okay, you're going to pay some taxes. But there's an advisor that comes to them and says, oh, no, I can set it up so you don't ever have to pay any taxes. You can defer the taxes, then you don't have to pay taxes. In the world that I work in, I get that coming across my desk about once a week, a new strategy that I have to go through and make sure, did they dot their I's, cross their T's on the tax code. So one of the things that they need to understand is there are aggressive planners out there. Mm-hmm. And there are multiple things going on. One in the Supreme Court, where they reversed what was called Chevron deference. And I don't want to get into tax law things because that's not actually specific to tax law, but it's going to change some of the tax law, because when Congress writes a tax law, it's never complete. There's always regulations after that. There's proposed regulations and final regulations to kind of, define any ambiguities and things like that. Mm-hmm. So you get this body of work. And then eventually someone disagrees with it, they do something wrong, whatever, and they end up in tax court. The judge is required to follow what the regulations are. Well, that was called Chevron deference. And again, not specific to tax law, it could be, a whole host of other different laws. But with the tax laws, that's the IRS, the Treasury comes out and says, well, here's what we feel the law meant. Here's how we defined it. Well, now with Chevron deference gone, the Supreme Court said it's gone. That means a judge could decide differently. That means all these regulations out there on taxes, people can challenge. So A, we're going to have a good portion of the tax law potentially challenged going forward. B, and again, not a political statement. You agree with this or disagree, but it's true. They've gutted the IRS. And because the tax laws have become so complex, they don't have the staff that knows this stuff. Mm-hmm. They're not complex. I just went through all this dissertation about how you need a specialist. Well, so does the IRS. So they don't have it. And on top of that, you have people that want to make money. And they know that there's a high net worth people, business owners, et cetera. Taxes are a rub, right? And they don't want to pay them, and they feel they're too high, especially if you're like in a state like California or Minnesota or New York, something like that. Illinois, and so they don't want to pay it. So it's an easy target to come and say, well, I have a way, and they look good. Some of them they dot a lot of I's and cross a lot of T's, but they still violate the tax law. So I've seen in the 34 years that I've been in business, I've seen a constant stream of advisors getting together with attorneys and or CPAs to come up with an idea that they feel that they've skirted around the tax code. And it violates the spirit of the code, even if it doesn't violate the actual code. Maybe they get away with it for a while. So in saying all that, what I would say is be cautious, be careful, make sure that, have diligence, discernment, I would say almost, to make sure that you're dealing with people who aren't just trying to make a buck off of you and you're, going not to pay. And a lot of it is focused on taxes. Mm-hmm. There was just an advisor and attorney down in Florida that just went to jail because of what they did. It was essentially what they were doing was fraud. And I've seen clients, taxpayers, clients, et cetera, get themselves dry. I had a client 20 years ago who, when I met him, this wasn't me doing it, he had $1 million frozen by the Department of Justice because he was in one of these tax schemes where they had told them, if you do this, you'll get a deduction for putting the money in. It won't be taxable as it grows, and you can take it out tax-free.
Oh, wow.
So I've seen a lot, and I'm sure you've seen a lot as well. So I would say, be cautious.
And so a lot of that legal structuring, I guess, if you will, if you're structuring a business, I mean, have you seen the actual structure of the business play any sort of role in overall tax strategies? And how would a business owner even know? I mean, if they're in the right structure, you see all these, legal Zoom commercials. We can make you an LLC for $49 or whatever it is. And so people are going out there and making these LLCs, but not really knowing, S Corp, C Corp, partnerships, all limited part. Like how can people understand the structure and what difference that makes in their business?
Yeah, the first thing to note here is that it is important. It's extremely important. It's not something to wash over. So I get regularly, this is the job that I have. I work with advisors specifically who have high net worth clients and business owners, and I regularly get fact patterns. Hey, I got a guy, I got a girl who has this situation. And one of my first questions always on the fact pattern is, are they C Corp, S Corporation, LLC, professional service corp? What are they? And the worst answer I can get is, well, I think they're an S Corp. You can't think. You have to know. The tax law matters. The C Corp versus, and it's not just taxes for sure. We've mentioned this before that there's legal aspects to it. There's creditor protection aspects to it. There's not only one reason. And two people in pretty much almost very similar situations, but who have different priorities. One might choose a C corporation, one might be a partnership. So it absolutely does matter. And one of the things you keep hearing is they keep changing the tax laws on it. And so I would say if there's any momentum, there's probably going to be a little bit more momentum towards people shifting from S corporations to C corporations and or just starting a C corporation. Because of some of the tax laws that just passed. I mean, we have C corporation highest tax rate, or the tax rate is 21%. All right, that not so long ago, it was 39.6. It was whatever the income tax rate was. So 21% tax. Now you have a double tax on that when you have the dividends come out. But there's different ways. I don't want to say around that. That's not the appropriate way to say it. But they tried to level the playing field in the 2017 Tax Act by creating this thing called 199A QBI deduction. So it's a 20% deduction for pass-through entities. Because if you're a pass-through entity and you're at the highest tax bracket, that's now 37%. You're at the corporate C corporation level, you're at 21%. Mm-hmm. Well, that doesn't seem quite fair. So what do you do with that? So they tried to lower the S corporation pass-through with this 199A deduction. It kind of phases out above certain adjusted gross income limits, et cetera, which is the complexity in all of this. It's nothing as simple. But I can give you dozens of different strategies that we employ on a regular basis where it matters if you're a C or an S. So and I think we'll talk about this eventually, the idea of eventually you're going to get out of your business. You're going to sell your business, transfer your business, gift your business, et cetera. If you're going to sell your business, there's this code section out there that a lot of folks don't know about called 1202. And that allows you, if you're a C corporation, to sell your business And prior to this new recent tax law, you could avoid certain businesses, the whole list of caveats, but certain businesses, you could avoid $10 million a gain. So if you started your business in your garage, and now it's worth $10 million and you have zero basis in it, there's a $10 million gain if you sell it. Well, guess what? If you're the right type of business and you're a C corporation, you don't pay taxes. So I've actually had that fact pattern given to me. And the question I was being asked is, how do they avoid some of the gains on the sale? And it took me, 3 meetings with the advisor to finally figure out that, oh, wait a minute, they wouldn't have any taxes to pay anyway. So save you taxes. It's just what the law says. If you're going to sell your business and you are having trouble finding a buyer and you want a favorable tax way of doing it, ESOPs work really well. You're essentially selling your business to a qualified retirement plan. It's also oftentimes leveraged, et cetera. And there's a whole host of tax advantages in doing that. It's not for everybody. Again, you have to run through the checklist, but an ESOP works really well. There are fewer tax advantages for S corporations. If you want to sell your business and you have charitable inclinations, one of the great things you could do is you could sell your C corporation through what's called a charitable remainder trust. You can actually defer the taxes on all your gains for a rather long period of time and support charity. It's a really slick, neat idea. Guess what? You can't do that with an S corporation. So I could go on and on with the different strategies that we have that I need to know whether or not you're a CS or a partnership. And sometimes they get stuck because they're in the wrong entity. So on occasion, depending upon what your business life cycle is, did you just have extreme growth? Are you adding shareholders or partners? Are you removing them? Those kinds of things. What is your goal? Where do you see your business going? Is really going to drive whether you're a C or an S. It's not as simple as, hey, C corporations have double taxation and S corporations and partnerships are pass through. There's a lot of other aspects of that.
Yeah. I mean, otherwise they wouldn't have all three of them, right? Yeah. But, and that also changes, how people pay themselves, whether they're salary or they're doing distributions or the, other owner benefits. Why does that mix matter of how a business owner pays themselves?
Yeah, I think a lot of business owners are familiar with this to a degree, but we'll go over it quick. The idea is if, and I get this a lot. Well, I need to get money out of my business for some purpose, whatever the purpose is. And I'll tell them, listen, there's only a couple ways to get money out of the business. You either make a distribution / dividend. It's not called that when it's a partnership, but we'll just say it's a dividend. It's a distribution, or you pay yourself compensation. I mean, those are basically the way you can loan yourself money. The company can loan you money, and sometimes people will do that in order to kind of avoid the tax hit, especially if you're a C corporation. Because an S corporation dividend you're not taxed. You've already been taxed on that money. It's just taking money out of the business and reducing your basis. But so the two key parts are, if you pay yourself compensation, you have payroll taxes. So the Social Security wage base this year is $176,000. So if you pay yourself W-2 compensation, you're going to have to pay 6.2% twice if you're the business owner. On up to $176,000. So you see a lot of business owners try to reduce their salaries to the lowest justifiable value. And that's important. It's got to be reasonable. If you're running a $10 billion company and you're paying yourself $50,000 as the CEO, it's probably not reasonable. And there's always that line, and you have to talk to probably an employment law attorney or someone like that who understands tax law attorney maybe to figure that out. But it's that, number one, and number two, basis. So, the higher basis you have in your business, when you eventually sell it, you'll have fewer capital gains taxes. So when you make a distribution from, say, an S corporation, that reduces, and same thing with a partnership, it reduces your basis. So now you have a lower basis. If you sell the company, you pay more taxes eventually later on. But, in an S corporation, like I said, distribution is not currently taxable to you. C corporation, it is. So that, again, we're going back to the CS corporation. It matters. But as far as how you get the money out of the business, because that's, you have a business so that you can, have those dollars for yourself personally. There's so many different ways to get it out.
So what are some ways that you've seen the business owners kind of reduce their taxable income? I know that you just mentioned that, wages are obviously taxable and have the all the different parts of the taxes that you're going to have to pay. And then distributions are a little different. Are there ways that business owners specifically can reduce that taxable income?
Yeah. My first go-to is always maximizing your qualified plans. So, and it really depends on the census of your business, the specific details of your business, how many employees you have, what their ages are, how much you pay them. It really matters. But there are ways to take a qualified retirement plan and you can get hundreds of thousands of dollars. We all think about a 401k plan as a qualified retirement plan, and whether you can only get so much money into those things. It's not enough for your high net worth clients and some of the business owners. But you can do what's called a cash balance plan. There's also a plan called a 412E3 plan. They're defined benefit type plans. And the appeal is you can get a lot of money into these things. Way more than you can into a 401k. Actually, you can layer on top of things and also do a 401k and get even more money into them. They are qualified plans, so you can't, you can discriminate to a degree. You can't completely discriminate, meaning you have to include all the employees if they're actually employees, W-2 employees, and all the laws that go along with that. But I've run into situations where my business is, I'm a dentist and I make $750,000 a year, and I got a couple dental assistants and an administrative assistant, and they make $35,000-40,000. I'm 50 years old and they're 30 years old or 35 years old. That fact pattern fits really well for a cash balance plan or a 412E3 plan. They're meant to be, by law, they're supposed to be permanent, meaning you're not supposed to, it's not for the business owner who says, hey, I had a good year. I got an extra $1 million this year I don't know what to do with. Next year, it's going to go back down. These are plans that when you have consistent revenue that you have coming in and you'd like to do so. So qualified plans are first. And then it gets kind of complicated because there are some things that you can do. There's a strategy called a captive insurance company that a lot of the bigger companies do, but smaller ones can do it. It's got a bad name. If you ever hear of micro captive, run away. Don't run from that. But a captive insurance company is, and I don't want to get into the details. We don't have nearly enough time. This is one of the more complicated ones. Yeah. But it's a way of getting a deduction for the contributions that go into this other this company that you create and own. You create another company. It's actually an insurance company. And the purpose of that insurance company is to cover risks that you typically wouldn't go to a property and casualty business for. So hurricane insurance, it could be whatever the risk is. And they're a little bit expensive to set up and administer. So it's typically when we're talking about bigger dollars. You get a deduction for the money going in. The idea is, generally speaking, if no claim occurs, there's no hurricane, then the company has profits. Well, the tax code allows you to avoid paying taxes on a lot of the profits inside that captive insurance company. The tax benefits are really, really, really good if you have a profit. So there's no tax on the profits. Well, guess what? You own that company. You got a deduction for the money going in. You didn't have to pay any taxes as it grows, and now you can kick it back out to yourself as owner of the company. So there are some complicated solutions like that. There are some that have fallen by the wayside because the IRS caught up to it. I'll say that. There are Section 79 plans, which are group term life insurance policies, a whole host of different things that you can do. There's, I don't want to get into it, but start with qualified plans, figure out if that works for you. If it's not enough or it doesn't work, talk to a tax advisor or talk to, somebody who understands this kind of stuff. Because there are ways to do it. All of them come with a risk, a cost, a something. You lose control, you lose liquidity, something. I've always said this before because I get this question every day that ends in a why. If I could do this, I say, well, if I had a perfect answer that allows you to deduct the contributions going in, not pay tax on the growth and take it out tax-free, I'd be telling it to you from my castle overlooking my golf course because I'd be richer than anyone in the world because everybody wants that. But that doesn't exist. But there are some ways, depending upon your fact pattern, to save some taxes.
And so you brought up insurance. I mean, are insurance kind of gets overlooked, what I've seen, or nobody ever thinks of it as a tax strategy. Everybody thinks of insurance as a death benefit. With the products that are out there now, what have you seen as far as insurance that can help high earners reduce taxes or protect their wealth?
Yeah. So the first thing you said is extremely important. It's one of those things that's not well known.
Mm-hmm.
And so I'm going to spend a little bit more time on this one than you probably want to as well, and a little bit of history. But I think it'll be eye-opening a little bit. So there's 2 points that I want to make on that. First, if you want to know if a particular concept, financial product, strategy, etc., is advantageous, here's a good rule of thumb. Look to see if the IRS and the government limited it. Did they put limits on it? I just mentioned captive insurance companies. There are limits on it.
Mm-hmm.
401ks, limit on it. Cash balance plan, there's a limit on it. Why? Because it's really good for the taxpayer, which means it's bad for the government, right?
Yeah.
So first rule of thumb is if they put a limit on it. And so you could see that an example would be 401k plans. You can only put so much in. Well, life insurance, cash value life insurance, if you fund it correctly, max fund it up to the limits that you can, minimum death benefit, max fund the thing, the cash values grow on a we'll call it tax deferred basis, but since you can take it out tax free, if you do it right, it's kind of tax free. The growth is tax free.
Mm-hmm.
You put money in, it grows, you pull it out tax free, and you can fund college education, you can supplement your retirement income, et cetera. And then if you die, it's the death benefit's tax free. So there's, other than you're using after tax dollars to put the money in, you're done with taxes at that point. So if I describe this to you, this financial product without using the word life insurance, people would be very interested. You say the word life insurance and people are like, they think a death benefit. I don't want to pay the premiums. Well, don't think of it as a premium. Think of it as a contribution to a financial product.
Well, sure. It essentially sounds like a Roth IRA.
It sounds exactly like a Roth IRA because it's taxed like a Roth IRA. So if you want to know, rule of thumb, do they put limits on it? They did. In the 1970s, wealthy people were throwing so much, they created new products that had this cash value growth in it, was just term. And rich people, high net worth clients, were throwing so much money into these things that it became a tax shelter. That's what it was. It was a tax shelter. It was a government-blessed tax shelter. Mm-hmm. And so in 1982, and 1984, and 1986, they created 3 different tax laws, TAMRA, DEFRA, and TEFRA. I didn't do the order right there, but those are the 3 that they created to try to make it so that it's valuable, but it's not a tax shelter. Right? They didn't want people having $980,000 of cash value in a policy that was $1 million death benefit. All right. So they had to create some kind of a corridor there. It's still obviously advantageous, but they created tax laws to minimize the tax advantage. So that rule of thumb you should at least, that's a green flag to go, oh, well, wait a minute, maybe I should look at it. Second story. And this one is kind of a historical one, but I think it'll appeal. So the federal government is required by law every single year to put out a list of what's called tax expenditures. These are another word for tax expenditure is a tax loophole. It's something in the code. It's legal. We're not trying to do anything aggressive. It's in the code and it gives you a tax break. An example is you can have health benefits paid by your employer. Mm-hmm. And the employer gets a deduction and you don't pay taxes on it. It's an economic benefit to you, but you don't pay taxes. Well, that's written into the code. That's actually the most expensive tax expenditure there is for the federal government. There are 171 now, I think, tax expenditures. They're required by law to report what they are and what the cost is to the federal government. If you jump back in time to 2013 and you went and you looked at the list based upon what was the most expensive tax break you could get to the federal government, which the flip of the opposite side of that coin is the most beneficial to taxpayers, number 15 is cash value life insurance.
Oh, wow.
It was one of the, you got 401k plans and you got benefit plans. And there's 171 of them. Number 15, which cost the federal government on an annual basis back then, $25 or $24 billion, was the fact that you didn't have to pay taxes on the cash value growing and you could pull it out tax free. And it was so important that the lobbying industry for the life insurance industry lobbied to get that off the list so it wasn't defined as a tax expenditure. Why would they do that? Because every administration, Democrat and Republican, it doesn't matter what party it is, every single administration comes in and looks for revenue. And what's the first thing they do? They go to the tax expenditure list and see which is the most expensive. Now, they're not going to make all of a sudden tax your health care benefits. They're not going to tax. They just tweaked charitable giving a little bit. Mm-hmm. One of them is you get a deduction, 100% deduction for making a charitable gift if you itemize. Anyway, so they went down what the life insurance industry wanted. They don't want them messing with that advantage because it's a huge advantage for them. So they lobbied to get it off the list. They had a legal technicality, turned to be right. It's off the list. If you go to the list of tax expenditures that the government is required to put out now, you'll see 171 of them, and you'll see death benefit on there being tax-free as a tax break. You won't see cash value life insurance. You have to go the whole way back to 2013 because it was over. I'm telling you that for a reason, opposed to getting into the financial product itself. If they put limits on it, and they went to great lengths to make sure that the government doesn't attack it, it's an advantage. And so most high net worth clients that I work with kind of understand that to have a portion of your portfolio invested in that kind of an asset where you can have asset, and then it also protects you from what if someday we have a 50% tax bracket again? You won't care because you have a good chunk of it in a tax variable vehicle. So that was probably more than you certainly anybody.
It's definitely one of those things. I mean, the way you describe it, it sounds exactly like a Roth IRA, except for the fact that you're not limited on contributing to it based off your income. So
that's why high net worth people can do that, because the high net worth, truly high income people can't do a Roth IRA.
Correct. Yeah. I mean, they can always do the conversions later, but the contributions you can't ever. Most high income earners didn't realize there was even a tax-free bucket that they could use.
Yeah. Right.
So no, I appreciate you bringing that up because it does differ quite a bit. And you mentioned this from traditional retirement plans in terms of flexibility, what you can use it for. Obviously, the tax treatment's different. So, we're always a big proponent of not putting all your eggs in one basket. So don't have all of your savings in a 401k. Let's spread that out. Let's get some tax-free money. Let's get some flexibility out there. So I think that's a fantastic way of doing it. But again, kind of going back to the business side of things, when you're looking at life insurance, I mean, how important have you seen things like, buy-sell agreements or key man insurance and stuff like that? I mean, how important of strategies are those to business owners?
So the biggest issue that I run across, when I was young in this business, I used to review buy-sell agreements on a regular basis. And I got to the point where I noticed something wrong in almost every single one of them. It may not be technically wrong, but it was wrong for the client. A lot of times it was technically wrong. And I used to have this saying, 70% of the buy-sell agreements I read are, something wrong with them. And then I ran across someone who had been in the business for, a long senior person, 30, 40 years. And he made the comment, that he's never read a buy-sell agreement that didn't have something wrong with it. And then I realized I'm missing 30% of it. Right? Now that I'm the senior guy and I've been doing this for a long time, I can honestly say 90 to 100% of the buy-sell agreements I read, something wrong. And it could be a tax-related thing. It could be how it's funded. And the other thing that I do for a living, part of what I do for a living, is read court cases. Mm-hmm. And you can't throw a rock without hitting a court case where business owners are suing each other, and it stems from their buy-sell agreement. So I'll even give you an example. I won't name the court case specifically, but there was a court case recently, and this happens all the time. This is just an example. The buy-sell agreement specifically said, it was the valuation provision. So a buy-sell agreement is a contract that business owners enter into that say, hey, upon death, disability, retirement, bankruptcy, divorce, any kind of a triggering event that might cause the shares to transfer, we're going to put limits on that. We're going to put requirements on it, rights, obligations, etc. Well, one of the rights or obligation is, well, if say death happens, well, maybe the other partner is required to buy them out, and that's what this case was. But for what price? Mm-hmm. What's the valuation provision? You want to set that up front, and it's important how it's drafted. So what they did is they drafted in there and say, well, shareholder A and shareholder B. If shareholder A dies, B has to buy out A for book value. Well, all you accountants out there know book value is not the actual value of a business. That's assets minus liabilities.
Mhm.
You know, it's a multiple of earnings. Frankly, it's what somebody would pay for it. So this particular business, and this was rather not too long ago, the book value of the business was $780,000. The fair market value of that business was $11.5 million. We went to court because one party wanted to pay 780, the other one wanted 11.5.
Sure.
The 11.5 lost because the agreement was not it was not, in their terms, it was not unconscionable, which I think it's unconscionable, but I'm not the judge. So I want you to think about the family that is left behind.
Yeah.
In this case, it would have been a wife. Husband passed away. Wife receives the business and has been living off that business that is really worth $11.5 million. So they're probably bringing in $300,000-$400,000 easily every single year off that business, and that's their lifestyle. Paying for college education for their kids, you know, those kinds of things. Husband dies. They don't get $11.5 million in value for it. They get $750 or $780. Now that remaining wife and children has to live off of $780. How much are you pulling off of $780?
Well, you get about $300,000 a year. Getting.
So that's what happened, all because a document that everyone ignores, and they don't even know they have it sometimes, said the wrong value. They actually had the agreement. They actually went to the trouble of doing that. They actually had a valuation provision in there, but because of that one thing. So that's a long-winded way of saying buy-sell agreements need to be reviewed on a regular basis. There was also a recent, for anybody who's got a potential estate tax problem, and keeping in mind the estate tax exemptions, $15 million, $30 million married now. So that's that kind of wealth. If you have an estate tax issue, the Supreme Court just weighed in on something. They just changed the tax law that's been around most of the time that I've been around, such that you could have a huge estate tax problem with a buy-sell agreement that's funded with life insurance. I won't get into the details of that, but that's another reason why you want to have those things reviewed. So just from a buy-sell agreement standpoint. Now, for the other big problem I run across is people who have businesses who wake up one day and say, I'm out. I'm selling the business. I promise you, if you had planned 5 years ago, 3 years ago, this day, you would get more for it, and the tax would be more efficient if you had done it 3 to 5 years beforehand. So the idea of not planning to do, no succession planning. Yeah. I look at it like staging a house. If you're gonna, do you wake up one day and go, "Hey, honey, we're selling the house," and put a sign out front? No, you have to stage the house. You might put $5,000 into a new door. You might, whatever. If that $5,000 would give you $7,000 in sale value, yes, that's what you would do. You put the furniture in a particular, you paint, you do all of these things. We have to do the same thing with a business, and it's obviously may take a little bit more time. Do you want to sell the stock or do you want to sell the assets? Yeah. Well, that matters. Being in a good negotiating position. The one thing that I see, I think you mentioned key employees for a second. Executive compensation. So I did a business owner survey back 4 years ago, with a firm that I was working with. And it is a national survey of business owners. And one of the questions that I put in there is, do you have any key employees that would be critical to retain through a transition of your business, whether you're gifting it to the next generation down or selling it to a third party or selling it to key employees or something along those lines? 80% of them said yes. Yeah. So that to me means the vast majority of business owners have key employees that are key to retain through a transition. And you can think through that for a second. We won't take the time to do that. You can see why that would be. If you're going to gift it to the next generation, but your top salesperson and your CFO leave because they only want to work for you, not for Junior, that's going to be a problem for Junior. They're going to have a hard time, maintaining the same revenue. Yeah. If you're selling it, the buyer knows. The buyer is going to look at your employees. They're going to look at your retention policies. They're going to look at your turnover and say, that's too high. I think that person is disproportionately responsible for the profits that come into your business, and they could leave because you don't have any financial motivation for them to stick around. So executive compensation packages, whether phantom stock plans or stock grants of stock or deferred compensation, there's something called split dollar we work with a lot. Providing a financial handcuff So they will stick around at least for a period of 2 or 3 years after the transition. What it did for you is you might be thinking as a business owner, well, I'm putting more money into retaining them. Yes, that's true. But the value of your business is going to go up if you're going to sell. So that's one thing they don't think about in the so-called staging of the business.
Yeah.
Take a look. What does your buy sell allow you to do? Have you staged it with your executive compensation? Have you created tax efficiencies and things like that? And then you also have to probably do some painting.
And there's a lot of moving parts here when you're looking at selling a business, and it sounds like these are some good starting points, some good kickoff points, is making sure your agreements are in place, that they've been reviewed, and they say what they need to say.
The first thing you have to do is get a business valuation. You have to know what the value is. I don't know that I've ever run across a business owner who underestimated what their business was worth.
Oh no,
that's always say it's worth a little bit more. That's not trying to insult business owners. It's the nature of the beast, because you know it better than anybody. Mm-hmm. Oftentimes, if you're the founder of the business, they think of it like their child. Like, I raised this thing, I grew this thing. It's more valuable. My child is more valuable to me than it is to somebody else. The same thing. So, but get a legitimate business valuation. You don't have to spend $30,000 to do it. There are less expensive ways to do it. Jaimin, I'm sure you have some ways that you can help them out with that. But
absolutely. So if somebody watching right now wanted to take, one step this week, or next week, in the immediate future, to kind of improve their tax strategy from a business owner standpoint or a high net worth individual standpoint, I know they're probably a little bit different, but what would you say is one step that they need to take now or to start that journey?
Inventory your assets and inventory your goals.
Okay.
All right. So the assets is exactly what it sounds like. I don't mean run through and count all the, tractors you have or whatever your business might be. Take note of what exactly is you have from a documentation standpoint. I know it's boring. It just is. But documenting or getting an inventory of exactly what it is your assets are, your legal agreements are. I can't tell you the number of agreements that I run into, employment agreements that wouldn't hold up in court for a day. So having an understanding of what they are, if they haven't been reviewed in 5 to 7 years, taking a look at them because laws change. But then maybe even more importantly than that, inventory your goals. What is your actual goal? What is your business? You've created a business plan. What's an exit plan? And maybe you don't have an exit plan. Maybe you have no intent. I'm in my business life cycle where I'm going to grow this thing and expand. That's fantastic. Then plan to succeed. Just put yourself in the future and say, I succeeded. What does that look like? And then, because when you talk to these advisors that I told you to go interview, they're going to need that info. That's the kind of the job that I do. I hate to say it, but garbage in, garbage out. If someone gives me a poor fact pattern, and even more importantly, they don't know what their goals are, I don't think I can help you reach your destination.
Sure.
So that's important. So I know that's simplistic, that's not technical or anything like that, but there is a form of practice out there called exit planning, where actually, you hear trust and estate planning, you hear retirement planning, education planning. There is an area of planning out there focused on exit planning. Mm-hmm. There are steps to it. It's a tried and true way of getting there. I already mentioned that the first step is a business valuation, but that's specific to exit planning. If that is your goal, it's business valuation, and while you have that, it's the next step is figuring out your goals. In every type of planning that I've run across, it's the same thing. That's why so many buy-sell agreements are improperly drafted, because they're boilerplate documents. Yeah. We're pulled one off the shelf and said, here you go, here's a buy-sell, and the business owner's like, well, they all must be the same, and nothing could be further from the truth. So, and it's all based upon what your actual goals are.
Yeah.
So spend some time to think about it. I know business owners, they're too busy, they wear multiple hats. That's a challenge. But and I'll say this, you can probably achieve way more than you think you can. So don't limit your goals.
Is it fair to say that even if somebody doesn't want to, say, sell their business the next 3 to 5 years, they're, like you said, maybe right in the middle of growth mode. They've got 10, 15 years. Is it safe to say that getting a lot of this stuff done now, getting the, team of tax strategists and advisors and CPAs and attorneys and all that involved. And now to get yourself working towards the right path is a smart move, or is it something that maybe they don't need to wait and they should wait until 3 to 5 years out?
I'm obviously going to say you should have get the advisors hooked up now. You don't need to pay them anything yet. Just interview them. Make sure you have them so you know. One of the probably number one questions I get after I've talked to high net worth client on estate planning or business owner or whatever it might be, hey, those are good ideas. I'd love to do that. Now it's time to implement. And they go, do you know any attorneys in Des Moines, Iowa? I'm in Pennsylvania. No, I don't. We don't all know each other, right? It doesn't work that way. So if you start interviewing at the point in time where, okay, well, out of the blue, someone made you an offer for your business.
Yeah.
Wow. So things pop up. Business happens really quick. Opportunities happen really quick. Interest rates change, not quickly, but they change. The markets move. The economies move. Tariffs pop up, and then they go away. There's all these different things that are going on. So having a team of advisors that are prepared to and specialize in certain things, you never know when one of them will have a good idea. And like I said, I run across professional advisors all the time who weren't familiar with something that I may have been, and vice versa, I may have been not familiar with. So the more the merrier.
All right, and kind of going along with that, I mean, how should someone vet these professionals? So, how do they know that they're not one of these, TikTok specialists that they actually know what they're doing and talking about?
Ask them for a scope of work agreement, see what it looks like.
Okay.
True professionals are going to charge sometimes, for the most part, they'll charge some kind of fee, and you know what the scope of work is, and ask for testimonials. Absolutely, 100% ask for testimonials. The one thing about business owners, actually, this is a niche. This is niche planning, right? Mm-hmm. High net worth individuals, and I'm talking about people, 20 million, 30 million. I've worked with. What day is it? It's Thursday. Tuesday.
You're busy.
Tuesday, the client that came through was worth $15 billion. So I've worked with all different levels of it. They have unique issues. Now, yes, 15 billion one has a really unique issues, but it's a unique marketplace. So find out testimonials. Do they work with people? I once created earlier in my career material that was based on target marketing, so to speak, which was construction company owners versus manufacturing owners versus tech owners versus agricultural businesses. They're all different. They have all different needs, etc. And find somebody who works in your field. Do you know the agricultural fields, for example? That's a different marketplace. Do they know that? So get testimonials and make sure that they work with people that are like you.
Okay. A little fun question here that we actually got in before this thing started, but I had an email. And I'm not sure what they were trying to get at here, but what is the strangest or most creative tax strategy you've ever implemented?
Oh, and now the strangest one I didn't implement. So let's just go with the strangest one that I've seen. Let's see. Right now, it's not strange. I'll go with complex. There's something out there, and I'll give you a fair warning because it's out there, called an LLC, a charitable LLC. So if you were to just, please don't do this, but if you did just Google charitable LLC, you'll probably run across the fact that Mark Zuckerberg of Meta did something called a charitable LLC. That's not what I'm talking about. It goes by the same name. What he did was he just threw a bunch of his stock into an LLC that he's going to make charitable gifts from. He's not required to. It's not a foundation. Didn't get a deduction for putting the money in. He just wanted to be able to make contributions to any charity and or political party that he wanted to. So that's why he did that. There's another thing out there called a charitable LLC, which is kind of aimed at business owners. And the idea is you put money into an LLC, you retain controlling ownership of it, but then gift the, I'll call it non-voting shares. It's not technically that, limited partnership interests into a charity. You get a big deduction for that. So there's your deduction. You're holding on to but you control all of it. And then what they do is they borrow money out of the LLC for themselves. So what did I just do? I got a big deduction for the charitable gift. I put money in and got a big deduction. The charity can't control anything.
Yeah.
I'm not going to make any distributions. If I ever made a distribution, the charity would get money. Maybe they make a 5% distribution once in a while, but I borrow the money out. And then I buy a life insurance policy with it. And what's a life insurance policy do for me? Well, I can grow cash value tax-free, and I can pull it out tax-free. So what did I do? Deduction. No tax when it grows, no tax when it comes out. What did I say we wanted to invent? And I'd be telling you from my castle.
I was going to say, I'm assuming this one's not legal considering our early conversations.
This is the problem. There are still people out there that think they dotted the right I's and crossed the right T's and thinks that it's okay. The people that went to jail that I mentioned in Florida was for this. Ugh. So I'm not saying, like, some people, very, very intelligent people with law degrees and CPAs and all that, think that they found a way to do this. You dot your I's and cross your T's. You can go on the IRS website and they're warning people about it. It was in December of 2024 they started warning people about it. But people will still, they'll play the audit risk and say, well, maybe I won't get audited. So it gets so much more complex than that. So there's some weird ones out there.
Well, and I think that's a big risk right now is people not thinking they're going to get audited because the IRS just got gutted, that they're like, oh, there's less people looking, maybe I'll have a better chance of getting by with some things. Well, now you're just rolling the dice with your life. So,
yeah, because it's not too far from the, hey, I had to pay back taxes. Oh, I had to pay penalties to fraud.
Yeah.
If you knew it was wrong and now that's fraud, now you're going to prison. So that's not something I ever want to play with.
Well, we did reach our time, so I want to, thank everybody for coming. David, if you have a couple more minutes, I'd actually like to kind of go through I don't know, an example, if you will, and just kind of see what your thoughts are on it. For anybody that wants to stick around and go through that with us. If not, thank you guys again for coming and watching. Again, we'll be doing these every month. If you have any questions over anything that we talked about, please, I've pinned the email that you just need to send any questions to info@assurancewm.com, and we will be happy to get you answers to anything specific that you would like to talk about, or just schedule a time to sit down and talk with us, and we can go through anything. But David, I just kind of curious, because I know that you've got so many different strategies in your head that you've used over the years. If you wouldn't mind, could I just give you kind of a generalized example of a business owner and just kind of see what your initial thoughts on what things that they could do?
Sure.
Okay. So let's say you've got a business owner that owns a company that does, $2-3 million in revenue a year. He's got 5 or 6 employees. Obviously, big goal is to save on taxes. Maybe wants to sell this thing in 5 years. He's married. He's got a couple of kids. And ask me anything else if you want, I can make up some information, but what are some just generalized strategies that you would look at when you see that scenario and you're like, you know what, he could do this right off the bat? Don't have any sort of qualified plans set up yet. Just like I said, have 5 or 6 employees. Where would you see something like that going?
Yeah, you broke the golden rule right off the bat.
Uh-oh.
Didn't give me any of his goals.
Okay.
So everyone wants to save taxes. So is it an exit planning thing? Does he want help saving taxes on? If I went, the first thing I would think of is probably something like a cash balance plan, because of the number of employees. When you have a small number of employees, and I'm assuming because there's a small number of employees, possibly some of them aren't paid as much and maybe are a little bit younger, kind of like the dentist example I mentioned. Mm-hmm. You can get a lot of money into something along those lines, and especially it depends upon what the rest of his portfolio looks like. What the value of the business is. Does he have other assets that are non-qualified that he could pull from? You don't want to lock up money. Is there any chance that he might consider expanding? Or is it really just, listen, I'm doing really well. I'm doing well enough that in 5 years I'm probably going to retire. A cash balance plan would be the first thing I would look at. Looking at qualified retirement plans and for 2 reasons. Number 1, taxes. It's just a good place to put your assets. Number 2, people forget this about qualified plans, but it has creditor protection.
Okay.
So if you've got a bunch of money sitting in your business, and you think businesses can protect you from creditors, that's true, but not from business creditors. So you might personally have credit protection, but not the business. If you take a fair amount of your profits and just give it to yourself, it's subject to your personal creditors. Keep it in the business, which you may or may not be able to do, depending upon if you're a C Corp or S Corp. It's potential that you can, an employee runs a red light and, kill somebody, business that might have liability. So if you can get a decent amount of money into a qualified plan, it might not be a bad idea for creditor protection purposes. Again, creditor protection is a whole nother issue. It doesn't protect it from all creditors. Anyway, so probably the first thing I would look at is from a financial standpoint. Have you looked at qualified plans? Because there might be a way that you can really get to the point where the vast majority of the contributions are going towards a business owner, depending on the fact pattern. So that's probably the first thing I would look at anyway, to see if they have interest in it. And then, once, you retire, if you're going to retire in 5 years, you can, depending on the plan and how it was structured, you can roll all that into an IRA. So you don't have to pay taxes on it. If you have other money that's already been taxed, well, you spend that first in retirement. Then don't worry about the rest of it till later.
Okay.
So it's probably the first thing I'd look at, just as almost everyone should at least consider, does that work for you? And
do you see that in most scenarios, because I've heard you mention it a couple times already during this, is cash balance plans. Do you see those typically being better vehicles than, say, like a solo K or even a 401k? I mean, if you've got employees, do the cash balance plans typically have more advantages for them?
Mostly it's because of the amount you can put in.
Okay.
So when I talk to a business owner and they're like, yeah, I could put a couple hundred, you mentioned they have, a couple $1 million worth of revenue.
Mm-hmm.
That's a couple $1 million worth of profits. Then yeah, they want to put as much as they possibly can into something, and you can't get that much into a 401k. So that's usually why that's considered. Okay.
And if it's let's just slight variable, it's a husband and wife or the two owners of the company. Because we've talked about ones before that have a cash balance plan with a 401k on top of it,
right,
to add more in there. What does that do? What does that look like when you have, because I think the plan that we looked at, they didn't have any employees. It was all 1099, but if you've got employees, does that make sense? And how much are you now planning as a business owner of having to contribute towards these employers or employees plans as well?
Yeah, the unique thing about cash balance plans is you're allowed to create classes. So it's a defined benefit type formula that ends up in a lump sum of money, which is weird. It's a hybrid type of a plan. So the idea is up to a certain amount of income level, I can create a formula for a higher class, and then a middle class, and then a lower class, or something along those lines. So you're minimizing the amount that's actually going into the lower end employees, and it can, you're going to spend a few bucks on it.
Sure.
But it has to be an advantage. That's why it has to be a true advantage. So if you're putting $250,000 into this thing for 5 years, it's $1.25 million. That's probably worth it to put money into it for some of the other employees. The administration isn't that expensive and things like that. And if it does end up discriminatory based upon the laws of qualified retirement plans, all that means is you have to give them a vesting schedule earlier. There's a few tweaks in there that means. We won't get into the details of it, but it's not like you can't do it.
Okay.
So
cool. Well, thank you for that. And thank you for taking the time today. I know you've probably got, 15 more of these things to do, 15 more meetings to do today. So I know you stay busy. But I want to thank you, again, for coming on and sharing all your knowledge with everybody.
My pleasure. Hope you have a good one.
Yep, you too. And anybody else who has any other questions, like I said, please don't hesitate to reach out. If it's something very complicated or complex, we will be happy to get David involved. But please just reach out if you have any questions. Thank you.